market analysis. Until now, you've learnt the theoretical foundations of trading. In this chapter, we'll learn the factual aspects of trading. I'll introduce you to different types of analysis, and you will analyze different types of charts. This allows you to decide where to invest and how much. We'll also learn to understand the market and figure out the direction it will take you in the future. There are two basic types of market analysis. Fundamental analysis. This type of analysis tries to predict future market movements according to a country's economic news. Technical analysis. This analyzes current market movements in comparison to past market movements. In other words, it tries to predict future trends based on past movements. This is done with the help of indicators, which are available on the trading platform. Fundamental analysis evaluates the economic positions of countries and the way in which economic news affects the values of their currencies and equities, or the value of the goods exported by those countries. The economic news published by these countries has a great deal of influence over market movements. Since the USA is the largest economy in the world, it is very important to follow it. Factors that determine the price of a traded asset. The following is an example of the global trading market. For instance, if a poor economic statistic is announced in Britain, many traders will want to sell the British pound. In other words, the supply of pound will increase, resulting in a decrease of the currency's value, thus a decrease in the value of the British pound. Example: if a crisis in an oil-rich Arab country is announced, the price of oil will increase. This is due to the fears that the supply of oil would decrease as a result of sensitive developments in the region. Supply and demand. Supply and demand form the foundation of economics. To understand this principle, we need to understand that as demand for an asset increases, or as its supply decreases, the asset's price will rise and vice versa. The following is an example which illustrates this principle. Let's say a farmer has 5 regular customers. Each day his chickens lay 10 eggs. One day his chickens only lay 5 eggs. There are the same number of clients, but a lesser number of eggs. Therefore, there aren't enough eggs for everyone, making each client more willing to pay more for each egg, thus resulting in an increase in the price per egg. In other words, the supply decreased due to fewer eggs, but the demand did not decrease, resulting in an increase in the value of the eggs. This can also go the other way around. Let's say that one day, the chickens decided to lay 15 eggs. So now the supply has increased, but the demand remains the same. In order to be able to sell all the eggs, the farmer must lower the price of the eggs. In other words, the supply has increased, causing a decrease in the value of the eggs. Demand is also subjected to change. For example, if one day the chickens laid their usual 10 eggs, but fewer customers come to buy them, the seller may find himself left at the end of the day without having sold all his eggs, requiring him to lower his price. In other words, the supply remains the same, but the demand has decreased, causing the value of the eggs to decrease. Fundamental analysis. Fundamental analysis is based on macroeconomic data that is provided for that country or currency, where each country or economic bloc, for instance the Eurozone, releases a particularly significant set of statistics each week. These announcements usually have an effect on the currency's strength. Below are a few types of important news announcements which have particularly strong influence and usually cause very strong fluctuations in currency markets. Important announcements: gross domestic product, retail sales, employment, unemployment rates, interest rate decisions, minutes from the most recent interest rate meetings, speeches made by influential figures in the market, IFO, Business Climate Survey, PMI, Purchase Managers Index, CPI, Consumer Price Index, ZEW, Sentiment Index, relevant only in Europe. Market announcements. Market announcements are indicators of a country's performance. Experienced traders know how to incorporate these announcements into their strategy. It's important to note that before an announcement is made public, forecasts for these announcements are made by experts. In many cases, the value of the underlying assets reflect these forecasts. But when the actual announcement differs from these forecasts, the market can become much more volatile and interesting. Those forecasts are called reviews. The following is an example which illustrates the effect of such an announcement on the market. On April 27, 2011, an announcement was made regarding a decision taken for the interest rate in the USA. The forecast predicted a decrease of 0.25%, but in reality, the interest rate remained the same. This resulted in the support level of the USD and was therefore seen in the assets rise in value on the chart. Chart types. Technical analysis is the study and investigation of the market's behavior using charts. Trading systems enable traders to analyze the market using their various types of charts. Chart analysis requires the development of visual skills. To develop these skills, let's first learn about the three most common types of charts. Line charts. A line chart is the most simple and basic of these three types of charts. It is created by connecting various price units over a given time period. Each point only represents the closing price. The line connecting all the points creates a chart that helps to identify trading trends, as well as support and resistance levels. Technical analysis usually requires more specific information than that provided by line charts, so a line chart is less appropriate for in-depth analysis. Bar charts. A bar chart includes bars which represent different price levels over a given time frame, distributed on a graphical diagram. These lines denote the following information. High price. This is the high point of the bar representing the maximum asset price for that bar. Opening price. Displayed to the left of the bar's body, representing the price where the bar opened. A bar's opening price is usually identical to the closing price of the preceding bar. Closing price reveals the results between the fight of the bulls and the bears over the course of that bar. The closer the closing price to the high price, the stronger the bull's victory over the bears over the course of that bar. Low price. The low point of a bar representing the strongest point the bears reached over the course of that bar. The distance between the high and low points of the bar signifies the intensity of the fight between the bulls and the bears. A short bar signifies a calm, quiet market, whereas a long bar signifies a volatile, stormy market. Japanese Candlesticks chart. The Japanese Candlesticks chart is similar to the bar chart, that it also represents the opening, closing, high and low points for that bar, but using a different display, which will help identify various trading patterns. The difference between the charts is that in the Japanese Candlestick chart, the opening and closing prices are enclosed in a rectangle. The use of different colors indicates an increase or decrease in price over the course of the bar. This is the most common type of chart. Trends. First, let us explain what a trend is. A trend is a combination of waves that creates the market's direction. Trends do not move in a linear downwards or upwards direction. Rather, they're hidden between the lines of the chart, requiring us to identify them on our own. There are three possible directions a chart can move in: up, down, and sideways ranging. We identify a trend using peaks and troughs. Basic technical analysis. Uptrend. An asset in an uptrend creates a series of increasing troughs and peaks. Downtrend. An asset in a downtrend creates a series of increasingly lower troughs and peaks. Ranging trend. An asset in a ranging trend creates a series of peaks and troughs at price levels that are more or less identical. It's important to remember that when creating a trend line, we can also use the slope of the trend to determine the trend's strength. The steeper the slope is, the stronger the trend. Support and resistance. The foundation of technical analysis rests on identifying support and resistance levels. Support and resistance are like floors and ceilings that restrict the price movement from above and below. A support level is a price level where the asset tends to stop moving downwards, reverses direction, and starts moving up. The support level is represented in the diagram by a horizontal or near horizontal line that connects several troughs. The more troughs on the same price level, the stronger the support level. Usually when a breakout of a strong support level occurs, a trend reversal can be expected. Therefore, the prices will continue to move in the direction of the new trend. A resistance level is a price level where the asset tends to stop moving upwards, reverses direction, and starts moving down. The resistance level is represented in the diagram by a horizontal or near horizontal line that connects several peaks. The more peaks on the same price level, the stronger the resistance level. The stronger the resistance level, the stronger the breakout will likely be when the price eventually breaks through the resistance line. The start of a breakout is an excellent point to enter a trade. Summary. In this lesson you have learnt about technical and fundamental analysis methods, and the different types of charts. Once you've learnt, understood, and practiced the topics of the course, you'll be equipped with the tools to become a better trader. I would like to thank you for participating in the course, and wish you success in any future path you choose.